DSCR loans are now the easiest way to qualify for real estate investment in 2025, but most investors, they still think they're way too complicated. This year's lending environment has totally changed, and the truth is, if you're not up to date on DSCR loan requirements, you're probably leaving deals on the table. If you don't know the new DSCR rules for 2025, you could waste time applying, get denied unnecessarily, or worse, miss out on cash flowing properties just because you thought you didn't qualify. I'm Andrew Russell, owner and founder of RCG Mortgage, 4-time winner of Broker of the Year, top originator across the country, and I specialize in working with investors on getting them the right mortgage products and achieving real estate riches. More often than not, a client is referred to me kind of at the end instead of the beginning. Specifically, I had a client that actually was referred by a real estate agent. They were originally trying to buy a 4-pack of properties all in once, 4 2-family properties all next to each other. And throughout the process, whatever lender they were working with, they were consistently checking their credit, making sure that, the score didn't change or whatever. It was very new to me. Typically you get your credit run and it's good for 4 months. This lender was every month doing some kind of a refresh just to make sure nothing happened. So it turns out this savvy investor had children, some of us do as well. And although mine are 7 and 9, this savvy investor's children were in college. Cool, no big deal. One of her kids actually just graduated college. So it turns out, if you know anything about college, oftentimes people take student loans. Student loans are very expensive. Colleges are very expensive. So because of that, this, child graduated college and was getting into the workforce. Didn't realize they had all these student loans. And why am I bringing this up? I think you see where I'm going with this. So the savvy investor is buying a 4-pack of properties, all 2-family properties. And right before closing, about 2 weeks before, the lender said, listen, we're actually going to decline you. And she said, why? For your credit profile, for your credit score. And she's like, I don't understand. These are sweetheart deals. I'm getting them under market. I'm a savvy investor. I've done this before. I'm not a first-time investor, first-time buyer. And they said, because your score actually dipped under a 680. And she's like, I don't understand. You said I had a 780. They're like, you did have a 780. It just dipped under a 680. You're no longer eligible with a 660 credit score. So what happened? As you could imagine, she co-signed for her child's loans. I don't remember if it was a son or a daughter. And when they graduated college, the loans came due. They didn't realize because, for whatever reason, listen, student loan servicing is very difficult. There's Navient, there's like Mohela, I think is they're called now. I don't even know how to pronounce the names. They're always changed to a new person. And I guess for whatever reason, her child didn't realize that there was a student loan and it was actually coming due and they didn't pay. So student loans, I think, don't report unless you're 90 or 120 days late. So like the 30 or 60 days, you just don't know. And then what happened was a whole wave of them. It was like 4 of them, I think, if I remember correct, magically hit her credit report with 90-day lates. So her 780 credit score, her profile, her precious credit profile, that was flawless. Multiple trade lines, multiple mortgages, nothing ever paid late. Outstanding credit score instantly went down to, I think it was about a 670 because there were several installment, which is a student loan, typically installment debt. There were several trade lines that now had 90-day lates and showing past due. So she was actually referred to us. So what she didn't realize, number one, she was going to the wrong place anyway. They were requiring her to put a lot more money down and the rate wasn't even all that competitive. It was somewhere that said they specialized in this type of loans. It's more of a commercial bank. Turns out they did not. That's number one. So she was in better hands regardless. Number two, the new DSCR 2025 loan options and credit score opportunities have completely improved. Specifically, you can now get down to a 620 credit score and get a DSCR loan. So it turns out her 660 credit score, 2 things happen. Number one, we actually have the ability with the credit agencies to tell her, hey, listen, and it kind of stings because, she felt it was her child's obligation, but if you get caught up on those several trade lines, I think it was 4. If you actually just get caught up, show us proof that you got caught up. We can get your 660 score back up at least to over a 680, number one. But more so, number two, there was no reason for a declination because she could have, with us, always been able to get a mortgage, even down to a 620 credit score. Now, granted, from a pricing perspective, the interest rate oftentimes and even the down payment is geared off of putting a certain amount down based on the credit score. So a 780 score was actually really good, unfortunately. So even though it went down to a 660 and we got up to a 680 again, just to get our better pricing, even though we could have proceeded anyway, rate was a little bit off, kind of is what it is, but it just showed her that she was working with the wrong place And of course, parents out there, when you co-sign for your kids' loans, it's a big problem if they don't pay. It becomes your problem. So when you co-sign, you're obligated just as much as they are. So just good food for thought. But we were able to go in, save the day, little tweak to her credit to get it back up to a 680, and she was able to successfully purchase all those 4 properties with no snags. And she was just going to a commercial bank. These DSCR investor loans for 1 to 4 families, even 5+ now, believe it or not, are just best suited with mortgage brokers who have access to the actual DSCR loan and not more of a commercial, feel to it. So of course, there's always the question, hey, Andrew, clearly you guys are saying you specialize in it. Your rate has to be super high. No, that's actually not the case. DSCR loans, before the pandemic, the interest rate was typically maybe 1%, no more than 2% higher than market. So, I remember a time back then, the rate was 3.5% on a 30-year fix. A DSCR loan was at 5, 5.25, 5.5, which is a fantastic interest rate. The pandemic hit, unfortunately. They came off the shelf, these loan products. They came back after, and the rates were at one point, I think in 2023, early 7.5%, 8%. On the best case, 30-year fixed, which is wild. So the DSCR loans, when they came back, they were at 9.5%, 10, 10.5%, 11, even I've seen as high as 12%, which is quite high comparatively over the last decade. And now, eventually, over time, more of these were done. I guess the loans are paying well and on time, which means the secondary market, Wall Street, mortgage-backed securities, all this good stuff. There's a big appetite for these types of mortgages. So the rate, so say this is your average 30-year fixed rate for 2 teachers putting 30% down on a purchase. This is your average DSCR rate. Say this was 3-4%. The gap is kind of shrinking. So, right now, if the 30-year fixed rate mortgage is 6 to 6.5%, you could still get a DSCR mortgage right now with good credit qualifications in the high 6s. So it shows you really shouldn't be far off from the 30-year fixed rate of a primary purchase with teachers. So there are some caveats. You have to make sure prepayment penalties and down payments and closing costs, there are some caveats of it, but the interest rate, the specific interest rate comparatively to a DSCR versus a typical vanilla conventional mortgage, it's very close. And of course, you allude to closing costs. Hey, Andrew, I'm sure DSCR loans have way higher closing costs than normal. That's not the case. Listen, if you take closing costs as a percentage of the loan amount on a $800,000 loan amount, you might have 1% more in cost off that $800,000, which is $8,000. But it is what it is. Listen, you don't, these loans aren't subprime, but they're not really going off of anything except for market rent, which is very aggressive. If you think about it, you get an appraisal. That appraiser tells you what he thinks the property is worth, number one, but number two says, what's the market rent? And that's really all they're going off, that appraiser and what he feels the market rent is. And as long as that rent, in so many words, covers the mortgage or, is close, that's the income qualifier. It's not your pay stubs, not your tax returns, not your bank statements. It's just that. So of course, closing cost or rate is typically a lot higher. The fact of the matter is just because the rate is so close, 1% in cost, it's really a good deal. And of course, hey, Andrew, I'm sure the down payments are so high on these, right? So much more than the normal conventional Fannie or Freddie loans on an investment. Actually, the answer is no. So on a 2 to 4 unit property, 2, 3, or 4 unit properties, legal 2, 3, or 4, you have to put down 25%. You could actually get away with 20% on the DSCR side. So believe it or not, it's actually better. You can put a little bit less money down on the DSCR side. Why? I don't know. Just remember, said in all my videos, he or she who has the money makes the rules, and they're just comfortable with a 20% down payment. And of course, Andrew, I've never done this. I'm stressed out. They're going to see that I've never, bought an investment, and they're going to say no. They want to see experience. So no, the 2025 DSCR loan options have gotten more aggressive. Specifically, first-time buyers, not even first-time investors. If you don't even own a house at all, with certain qualifications, you actually can qualify for a DSCR loan, let alone a first-time investor. So believe it or not, for 2005, moving forward, unless there's a huge economic, issue or downturn or, something with house values, which doesn't seem to be happening anytime soon, these loans are here to stay and they're only getting more aggressive. All right, so I'm going to talk about right now the differences on the 2025 moving forward, the GOAT, greatest of all time, DSCR mortgage for investors, some of the cool changes that happened, some of the specifics that you as either a novice, an investor, or just somebody who loves the videos that your boy does. We're going to go over all the differences on these different mortgage programs for the DSCR side, what it means with down payment, what it looks like with credit score, how much money you have to have left over in the bank. You even have to be a seasoned investor. We're gonna go over all that. Before we do, make sure, guys, you hop in the description, click the link, and download our DSCR guide, the GOAT of all investment mortgages. download the guide. It's free. I promise we're not going to stalk you out, text you, email you, show up at your house, knock on your door, and ask you for any type of donation. But make sure it's a free guide, and it's really killer. My marketing team put it together, and it's awesome. Hop in the description, click the link, get that free guide. Because if you're thinking of investing, or if you actually are an investor right now and just aren't aware of these loans and what's available to you, you're going to want to have that guide. All right, guys, so our DSCR loan options that have improved for 2025, and it's a wild thing to say. I'm not sure what happened this year. This year went real fast, guys. Soon to be 2026. I'm sure it's only going to get better. Just because the way the market's going and some of these loan options are getting more aggressive. So the 5 things that I want to touch upon right now are the ratio. What the heck is a ratio, right? You go to the dance and it's, girl to guy ratio? No. The ratio is going to be the ratio of the market rent versus the actual mortgage payment. Does it have to be equal or greater? Could it be less? That's crazy. How could it possibly be less? Well, guess what? It can. Or maybe we don't even look at all. We'll go over that together. CS, no, for your video gamers, it's not Counter-Strike. It's credit score, right? So the credit score, what's allowed now? Where is it going? Back in the day, what was required? What is now, which has gotten a little bit better. So we'll talk through that a little bit. Down payment, right? As we alluded to, does it have to be 25, 30, or 35, 40% down? No, we'll go over that shortly. Docs required. I'm sure endless paperwork, right? You hear mortgage and you hear in your head whether you got one before and you have PTSD, so much paperwork. It's actually not the case. Some was no paperwork, believe it or not. We'll talk about that as well. And the whole thing around Airbnb. Could you buy a property that has horrible average monthly market rent over the year, but what if, in June, July, August, 3 months of the year, it crushes it, with either Airbnb or we'll put short-term rental, right? What if it absolutely crushes it? We could look at that because that's actually a new thing and that's allowed as well. You can buy a property that maybe you even live in a portion of the year, right? Because an investment, you can't live there. Maybe you use it here and there, on the investment side. Maybe it's a vacation place or an investment Airbnb or short-term rental spot, and you use it maybe a weekend out of the blue, nothing too crazy, but you use it from an investment perspective pretty much all year. But it's a short-term rental piece. So like maybe June, July, August, maybe the summer, maybe it absolutely crushed it. Maybe it's in the Hamptons, maybe it's in Miami on the water, something like that. Maybe it's somewhere on the West Coast. It's something that's actually allowed right now, and we'll go over exactly how, and we'll show you why. So the first thing is the ratio. So when you think of a ratio, you think of, nowadays, you think of, say, like 1.25, you think of 1, you think of 0.75, and you think rent is less than, I feel like I'm back in high school math. Rent is less than 0.75%. So if we, these numbers are a lot of numbers here, guys, but what does it mean if we just break it down real easy? I always use a very clear example. You have $1 million sale price, as the example of, remember the, young lady, the investor who had the kids, didn't pay the student loans on time, 20% down off of this is $800,000 loan amount, just always roughly a rate of 7%, 7.5% APR. So you figure it's like $5,600 a month plus tax and insurance. She was about $7,000 all in. All right, tax and insurance about $1,400 a month. So this is just a very rough example that we always work off of just to keep it clean. This is a very actual real example though. $1 million sale price, 20% down, $800,000 loan, 7% 30-year fixed rate interest rate. It's about a $7,000 payment. So a 1.25 would be $8,750. This would be $5,250. Obviously, a 1-to-1 is $7,000, and under that is under this number, or maybe we don't even look at it. These are the options as of late for the ratio. So specifically, this is all market rent. So $8,750 mortgage payment. Remember, we'll bring it over here, $7,000. So as long as this property, which was a 2-unit, as long as you add together the 2 units market rent, is it going to be $7,000-ish? That's a 1-to-1 ratio. Is it $8,750? That's a 1.25 ratio, meaning 1.25 of this mortgage payment is the actual rent, which is really good because there's extra love in there, which means oftentimes the interest rate offering is actually a little better. Lenders are willing to give you a better rate if the cash flow is so good that there's a surplus. Now, it's crazy to think this loan is based on market rent, and what if the rent is not enough to cover? They allow it. So if it's under $7,000 in this specific example, but over $5,250, it actually still qualifies. Now, what's the catch? You might have to do a little bit higher of a down payment, or the interest rate might be a little bit higher, but it's doable. And then again, if the market rent is really low, or you don't want, so it's like a no rent, we'll call it, we're not going to check any type of rent. It's just going to be straight up, off of the down payment and your credit. We don't care about what the rent is. Again, the catch is the rate's going to be even higher. Down payment might be a little bit higher. This is a lot as well. So these are 4 examples. Either the rent is so good and so high, you're going to get a better interest rate because it's so much more than the actual mortgage payment, or the rent is the mortgage payment pretty clean on a one-to-one basis, or the rent's lower, but it's close, right? That's the third option. Number 4, for whatever reason, you love the property. I don't know. You have to have it. There's got to be a reason. Maybe you're going to renovate it, and then it'll be worth so much more. Or the rent will be higher when you renovate it. You could do the no check program. Now, again, it's a frame of reference. The 1 1/4 program, this rate could be at 6.5%, right? Just for argument's sake, 6.5. Maybe the 1-to-1 program, the rate could be 6.75. Maybe the 0.75, this could bring it to like 7.5. Just so you can see, this is rough. We're not even using APRs. Just give you guys an illustration here. If the going rate for right now, if the going mortgage rate is 6.5 on a normal 30-year fixed rate primary, it's very close. Believe it or not, even on an investment where the rent is high, it's a little bit higher on a 1-to-1 ratio, but good. 0.75, meaning like the rent's a little bit less than a 1-to-1 basis, gets a little bit higher. Now you're in the 7.5 range potentially, just as a frame of reference. And I only know this because I've done, a lot of these is typically how the rate stack goes up. And then this one, bad news, guys. Could be as high as 8.5, even up to I've seen 9.25. So again, you really have to have a reason you want to buy because the rate's a lot higher, but it's still nonetheless is doable. So as an example, if you have unit 1 and unit 2, say it's $3,500 for each in rent, you add that together off of the appraisal, the market rent, $7,000, you're at a 1-to-1. If for instance in unit 1 and unit 2, somehow you get to $4,500, the new construction, somehow you're getting a sweetheart deal, rent is high in the area, you add these two together, you're $9,000. So now you're eligible for the 1 1/4 program with the better interest rate, 1 1/4 from a rent to mortgage payment perspective. If for some reason, they're, right, unit 1, unit 2, they're $3,000. That's $6,000 in market rent. If you add them together, that's less than the 1-to-1, higher than the 0.75. So all that means is it qualifies. You might have to put maybe an extra 5% down, or interest rate's going to be a little bit higher, guys. And then lastly, if for whatever reason it doesn't work out and the rent is low or the property needs work, whatever it is, now you're going to pop up to 8.5 or 9 1/4. So this gives you an illustration on the first piece, which is the ratio. Now credit scores, the second piece where you've seen some, good improvements. When these programs first came out, so let's say early, you needed a credit score of, 720, I remember, plus, which still, I've seen some wanted at 740. So you needed a high credit score and a really good credit profile. Credit profile means you have mortgages, you have installment loans, you have credit cards, you have student loans, all that stuff. They wanted no lates, flawless credit profile, which shows if you're paying things on time, and a credit score, which is 720. I could tell you now, so it's early, and I could tell you present. You always want to call this past, right? Past, present, future. So present, you can get away with a 620 credit score, believe it or not. So I've, the program has improved by 100 points. So why is that? Is another crash going to happen? No, it's just because, it's kind of like they test it, right? So you test the product and the performance. Specifically, are people going to pay? The 720, yes. And all of a sudden it goes to a 680, which goes down. They're paying on time. Cool. 660, 640. 620 has always been kind of like the floor. You never want to go into a 620. Once you see the number 5, lenders typically get nervous. But 620 is actually, for the second side of the conversation, is currently available to get a DSCR loan, which is crazy, but it's doable. You can buy an investment property with 20 or 25% down with a 620 credit score. Absolutely. Think about that. The third thing is a down payment. So, initially you had Fannie, Freddie. So when you thought investment purchase, non-commercial, kind of weird bank. On a 1, it was typically 20%. On a 2 to 4, it was 25%. So now here comes DSCR, right? So DSCR. So on a 1, you can actually get away with, I've seen 10 up or 15% down as a minimum, depending on the lender that you work with. It sounds cool, guys. No one puts 10 or 15% down because the pricing gets spicy. So you see how these programs, 6.5, 6.75, put less than 20% down, the rate gets jacked up. So would I even do it if I were you? No. But comfortably on a 2 to 4 unit as well, 20% is doable. So as you can see, you save on the DSCR side from the down payment. So the down payment opportunity for DSCR is a lot better at times than doing a conventional loan. Because you think $1 million property, if you can save $50,000 out of pocket in liquidity, you can take that money, you put it in the market, you can potentially invest in some kind of crazy crypto. That's like the cool thing now, right? Or you take that money, you could renovate the property, or even use that $50,000 that you save in liquidity on that new purchase and put it into the next purchase you're going to do. And you're already, a portion of the way there, which is super cool. So the third thing, the down payments. Down payments have become a little bit more aggressive on the DSCR side, so that it's more competitive or less of a down payment required than a conventional loan. The fourth thing is what docs do you have to show to qualify? Andrew, you probably have to show pay stubs, W-2s. They're going to want to see, your 1040s or tax returns, right? They're going to want to make sure, you're a real person showing real income. They're going to want to see your retirements, 401ks. When you're just going off market rent and down to a 620 credit score now, they're going to want to see, your blood type, if you're a great parent. No, believe it or not, these programs have gotten so much more aggressive. So what do we require? You get an appraisal. That appraisal shows market rent. We look at your credit profile. Now, not even 2 months. We get 1 month of your bank statement showing enough money to close. And they don't even necessarily want a ton of money left over after. And that's it. If you're buying in a corporation or LLC, they're going to want those corp docs before closing, right? Articles of organization or, whatever the corp docs are, showing that it's in good standing. If that's going to go in title or deed, the actual LLC or corporation. But that's it. No other documents. Maybe throughout the process, they'll ask for some letters of like, hey, this popped up on our searches. Do you own this property? Insurance information, but regardless, the typical documents you would have needed over here for Fannie and Freddie when you did an investment purchase, they all go away. None of this stuff. We're going to cross it out, right? Got a messy whiteboard here, but you don't need any of this stuff on the document side. So from a document perspective, it has gotten so much more streamlined. It's so easy to buy, especially if you use the right company who works with the right lender. The last one, the Airbnb short-term rental side, this is super exciting and super cool. So I just had a real-life example recently. So I had a $700,000 sale price. They wanted to put down 20%, so it's a $560 loan. Let's say the mortgage payment here is about $4,000. And that $4,000, when you added tax and insurance, it was another $1,000. So you figure that's a $5,000, right? We just made it here. $5,000 a month mortgage payment. So what happened here was they thought they didn't qualify because the average market rent over 12 months. Now this was a property by a very popular lake that's a super hot destination in the summer. You guys have probably been there. Many people have been there. It's actually in Lake George. Super popular when it's nice up. In the winter, it becomes a little bit of a ghost town. So if you get a renter for all year throughout a 12-month season, I think the rental was about like $2,500 a month. So they didn't want to put more than 20% down. They didn't want to do the program up here, right, where it was like the no ratio. We're not looking at the rent with a really high interest rate. They wanted the good stuff. So $2,500 versus $5,000, it's very low. So they thought it just wasn't going to work. But they were like, so I was like, well, why are you going to buy this property? Is it sentimental to you? Like, what's going on here? So they said, no, from a seasonal short-term rental perspective, if they didn't even rent it the other 9 months of the year, if you look at June, July, and August, each month, somehow, I have no idea how, but this property netted, it would be about $40,000 each month, about $10,000 a week. So 40, 40, 40, right? So again, just to reiterate, this property, if you rented all, there was no market for it. So they just come up with the numbers, $2,500 a month if they rented all 12 months. If they didn't, if they just did it per seasonally for the summer, Airbnb, short-term rental, then they actually, it was about $10,000 a week. It was like, was that $1,500 a day to rent this property in the summer. So if they did that, just using market rent off of that, for those 3 months, for the short-term side, $40,000 a month, that's $120,000. So if you look, $120,000 for the year, right? You divide that by 12, that's $10,000 a month. Now, some lenders take a 20% haircut off that. Not sure why. Don't ask me. Remember what I said? He or she who has the money makes the rules. So that if you take 20% off the top or 80% of that $10,000 number, now you're down to $8,000. So this is the qualification number. So they don't even have to rent it for the other 9 months. Those 3 months in the summer, the short-term rental side is $120,000 for the year. That's $10,000 a month. If you take the little haircut for, they just want to be a little conservative with these, that's $8,000 a month, and $8,000 is greater than $5,000. So they're eligible for this amazing price program. And it just goes to show that as the market evolves and short-term rentals and Airbnbs is now obviously a thing and it's here to stay, even these DSCR loans are improving. And that's why I feel like from 2025 to 2026, it's only going to get better. So if this really resonated with you guys and it really hit home and you're an investor and you have all the questions in the world, what's the down payment, Andrew? What are the actual market rates? What is it looking like? Are you being honest here? What's a real turn time? What's the true expectation when we work with someone on the DSCR side? Make sure, guys, you watch our next video. The next video is DSCR, all the FAQs, the frequently asked questions for DSCR loans. We're gonna go over everything, soup to nuts. Make sure you watch the next video.